You know what most people don't realize when they buy a house? They think the biggest financial challenge is saving for the down payment. But the real challenge actually starts the moment they sign the mortgage papers. In that moment, everything feels like progress. You've finally done it. You've bought a home, you've achieved stability, and you've entered what people call the next stage of life. But behind that emotional moment, something very different begins quietly in the background. A long-term financial structure starts operating against your time. Not in a dramatic or visible way, but in a slow mathematical way that most people never fully understand until many years later. Because a mortgage is not just a loan. It is a long-term interest system where time is the most expensive factor you will ever deal with. And the most surprising part is this. Most people don't realize how powerful that system is until 10, 15, or even 20 years later, when they look at their remaining balance and ask themselves a simple question. Why do I still owe so much when I've been paying for so long? To understand this, let's simplify it. Imagine you borrow $600,000 to buy a home. You agree to repay it over 25 or 30 years. Every month, you send a payment to the bank, and on the surface, it feels like steady progress. But inside that payment structure, something very important is happening. In the early years, the majority of your payment does not actually reduce your loan. It goes toward interest. That means you are not really building ownership as fast as you think. You are mainly paying the cost of borrowing. So even though you are consistently paying every month, the actual reduction in your debt is slow at the beginning. Meanwhile, the bank is collecting predictable returns from day one. And this is where two people, starting in exactly the same situation, can end up in completely different financial realities over time. One person follows the standard system without questioning it, pays monthly, never changes anything, and assumes this is just how mortgages work. The other person learns how the system actually behaves and makes small strategic adjustments along the way. And over time, that difference becomes massive. Not because one earns significantly more money, but because one understands how to reduce interest, shorten time, and use money strategically instead of passively. Now let's talk about the first powerful strategy, changing how often you pay. Most people default to monthly payments because that's how mortgages are presented. It feels normal, simple, and automatic. But there is a subtle shift that creates a surprisingly large impact over time, switching to bi-weekly payments. On the surface, this does not feel like a big change. You are still paying from your income, still following a schedule. But mathematically, something interesting happens. A year has 52 weeks. If you pay every 2 weeks, you make 26 half payments. And those 26 half payments equal 13 full monthly payments instead of 12. That means, without feeling a major difference in your monthly lifestyle, you are effectively making one extra full mortgage payment every year. That single extra payment does not just reduce your balance slightly, it permanently reduces the principal faster than expected, which then reduces how much interest is calculated in the future. And that is the key idea most people miss. Mortgage interest is not fixed on the original amount forever. It keeps recalculating based on what you still owe. So if your balance goes down faster, your total lifetime interest drops significantly. Over time, this simple change alone can reduce your mortgage duration by several years and save tens of thousands of dollars depending on your loan size. Now let's go deeper into an even more powerful strategy, extra principal payments. Every mortgage payment is split into two parts, interest and principal. Interest is the cost of borrowing money. Principal is the actual loan amount you owe. The critical insight is that interest is always calculated on the remaining balance. So every time you reduce your principal early, you are not just paying off debt, you are reducing the base on which future interest is calculated. That means every extra dollar you put toward your principal has a double effect. It reduces your current debt, and it prevents future interest from ever being charged on that amount. This is where even small amounts become powerful. Adding just $100 or $200 extra per month may not feel significant in your daily life. You might not even notice the difference in your spending. But over 10, 15, or 20 years, that small consistent decision creates a large reduction in total interest paid because it continuously shrinks your loan ahead of schedule. And the earlier you start doing this, the more powerful it becomes, because early mortgage years are the heaviest in interest charges. Now let's talk about something that looks like a shortcut, but can actually become a financial trap if misunderstood: refinancing. Many people hear that interest rates have dropped and immediately assume refinancing is a smart move. And sometimes it is, but not always. Because refinancing is not just a rate change, it is a full reset of your mortgage structure. In many cases, it replaces your remaining loan with a brand new mortgage, often extending your amortization back to 20 or 25 years again. So even if your monthly payment goes down, your total lifetime interest can actually increase if you are not careful. On top of that, refinancing comes with real costs: legal fees, appraisal costs, administrative fees, and sometimes penalties for breaking your existing mortgage early. That is why smart homeowners don't make emotional decisions here. They calculate the break-even point first. If refinancing saves $150 per month but costs $6,000 $10,000 up front, it takes 40 months just to recover the cost. If you plan to move or refinance again before that, then it becomes a loss, not a benefit. Next, let's talk about something most people completely ignore: mortgage features and flexibility. Many people shop for mortgages based only on one number: the interest rate. The lowest rate feels like the best deal, but in reality, mortgages come with conditions that matter just as much as the rate itself. Some mortgages allow large prepayments without penalties. Some allow you to increase payments annually. Some allow portability if you move homes. Others are extremely restrictive. And here's the important insight: flexibility has value. A mortgage with slightly higher interest but strong prepayment privileges can actually save more money in the long run than a lower rate mortgage with strict limitations, because flexibility allows you to aggressively reduce your principal whenever you have extra cash. And that ability to act is what creates long-term savings. Now let's move into one of the biggest hidden financial traps: lifestyle inflation after buying a home. This is where many people unintentionally damage their long-term financial position. After buying a house, there is a natural psychological shift. People feel they deserve upgrades: better furniture, a new car, more subscriptions, more comfort, more spending in general. And slowly, the gap between income and expenses starts shrinking. At first, it feels harmless, but over time, it reduces your ability to handle your mortgage aggressively. Meanwhile, financially disciplined homeowners do something very different. They keep their lifestyle stable after buying a house. Sometimes they even reduce unnecessary spending temporarily, because every dollar not spent becomes a tool to reduce debt faster. And this creates a powerful cycle. Lower debt leads to lower interest. Lower interest increases cash flow, and increased cash flow allows faster repayment. Now let's talk about credit and renewal power. Many people think credit score only matters when applying for a mortgage, but in reality, it affects your entire mortgage life cycle. When your mortgage term ends and you renew, lenders often look at your credit profile and financial behavior. Even a small interest rate difference, like 0.5%, can lead to tens of thousands of dollars in difference over the life of a large mortgage. That is why consistent financial habits matter. Paying bills on time, keeping credit utilization low, and avoiding unnecessary debt all contribute to better long-term mortgage outcomes without increasing income. Another powerful but overlooked strategy is how you use extra income. Whenever people receive bonuses, tax refunds, overtime pay, or side income, the natural instinct is to spend it. Lifestyle upgrades feel rewarding, but financially strategic homeowners treat that money differently. They apply it directly toward principal payments. And because their lifestyle does not change, that extra income silently reduces years off their mortgage over time. And finally, everything comes down to one critical concept: timing. Mortgages are structured so that interest is heaviest in the early years. That means actions taken early in the loan have a disproportionately large impact compared to the same actions taken later. A small extra payment in year 1 can save significantly more money than a larger payment in year 10, simply because of how interest compounds over time. So when you combine all of this together: payment frequency adjustments, principal prepayments, smart refinancing decisions, mortgage flexibility, credit discipline, lifestyle control, and strategic use of extra income, you begin to transform the mortgage from a passive burden into an active financial system you can manage. And that is the real difference. Most people simply own a house and follow the system, but financially aware homeowners interact with the system. They don't just pay the mortgage, they optimize it. Because in the end, financial freedom is not just about how much money you make. It is about how efficiently your money moves through time and how early you decide to take control instead of letting the system run on autopilot.